Good morning, everyone. This is your tutor CPA Charles Cafe, and today we are going to look at financial reporting. We are going to be resuming our series on financial reporting, that is CPA paper 8 level 2. Today we are going to be looking at the overview of the syllabus, and we are going to be looking at some items that are within the scope of financial reporting as far as CPA level 2 is concerned. So without wasting more time, let's kick off. I urge all of you to subscribe to the channel and be able to share, comment, and let also others have a benefit of what you are going to be receiving. So the first slide is all about the elements of financial statements. And the reason why we are talking about these elements of financial statement is not because we just want to talk about them, but they are really important, because you need to know what are some of the elements that we have within our financial statements. We have to distinguish between elements and the components. Elements, we are talking about we are not talking about the components. The components of financial statements, those are the income statement, or what we call the profit or loss and other comprehensive income, the balance sheet, or the statement of financial position, and the cash flow statements. Those are mostly three components. But when you are talking about the elements, we are talking about the items that are forming up those statements we are talking about. So these are defined according to the revised framework, that is the revised conceptual framework of March 2018. So these definitions are of March 2018 as they were revised within the conceptual framework. So the first element of financial statements, we are going to categorize them as elements that are within the statement of financial position, that is the balance sheet, or the items that show the financial position of an organization. One, we have the assets. When you look at the assets, within the definition of assets, you will see mainly there are three items that you need to focus on whenever you are defining an asset as per the revision that was made. One, you have to look at the present economic resource. Secondly is they are supposed to be controlled by an entity. And thirdly, they must be as a result of past event, or we must have acquired them in the previous periods. Actually, when you are talking about the assets, we look at the assets. Not all assets are going to be helpful to us. when we talk about the assets, we are looking at those assets that can be able to bring value or to add value to the organization, and that's what we call the present economic resource. From your economics, you know how an economic resource is something that can bring something on the organization. So these are assets that we have within the organization, but they are able to add something or to add value to the organization. They may be in terms of they are used in the production process, they are used to earn some money to the organization, as we are going to be seeing them. So we are saying assets, those are present economic resource controlled by an entity as a result of past event. You can't say I have an asset and you have not yet even acquired it. So you must have acquired it. That's what we are talking about. It must be as a result of past event. It is a present economic resource controlled by an entity as a result of past event. Secondly, let's talk about the liabilities. Remember these when we categorize them in terms of the financial position. You know, our balance sheet starts with the equity equal to assets minus liabilities. So when we look at those three components, those are the ones that are making up the balance sheet. The second one is a liability. A liability, it's an obligation, or someone must be demanding, or the company is supposed to transfer a certain amount of money to the person that is owing, that is demanding the organization. So when we are talking about the liabilities, we are looking at the present. It must be a present obligation. You can't be having the obligation which you have already settled already, and you call it a liability. It must be a present obligation. Secondly, the entity must also transfer an economic resource. It must be that liability must be quantified to the extent that upon clearing that obligation, the company is going to transfer certain amount. It may not be necessarily money, but something that can be valued. And lastly, it must be as a result of past event. So those are the three items that are making up our definition. We are saying that the present obligation of an entity to transfer an economic resource as a result of past event. That's what we call a liability. It's an obligation whereby we are supposed to transfer a certain amount of money. It may be money, it may be other resources, so as to settle it, but it must have occurred in the previous periods. The last one, as far as the elements of financial position or the balance sheet are concerned, we have the equity. Equity is where we find the financing component in the organization, where we find the share we've contributed, the profit, the trend earnings we have been making for the years, and all that makes up the equity. And we are saying to get your equity, it's remember when these shareholders, they are giving you money, they give you money, you purchase assets. When you purchase those assets, you may purchase them on either credit or you pay by money, but the money you've got it from the shareholders. So that's what we are talking about, the equity. The equity, it is the residual interest. We have to also look at it in the residual interest. Here we consider also three items. We consider the residual interest, what remains there in assets. The residual interest, then it's supposed to be in assets of the entity. Then when you have deducted all the liabilities. In other words, it's what remains after settling all the liabilities. You know, we settle all our liabilities using the assets we have. What has remained there is what we are going to be distributing either to shareholders and others if at all the business is going to wind up. So it is a residual interest in the assets of an entity after deducting all the liabilities. And here we have a formula: equity equal to assets minus liabilities. So what remains there is what we call the equity. So let's look at the elements that are relating to the financial position. The financial performance of an organization. That's the elements that are within the income statement or profit and loss and other comprehensive incomes. One of them we have is incomes. Those are the things we find in the income statement of any organization, and we are defining these items according to the conceptual framework that was revised in March 2018. So if you are using the old version, I know there are other ways you can define these, but we are going as per the standard. And we are saying incomes, these are increase in assets. We have increase in assets. When assets are increasing in value, we call it income. When liabilities are reducing, we call them income also. For an instance, you can talk about if let's say you are buying goods on credit and you are getting discounts, that trade discount, we call it as an income. That's why we record trade receivable as in terms of the other incomes as in regards for the financial statements. Because when someone the goods are supposed to be for 10 million and you end up paying 2 million, it means that you end up paying, let's say 8, that 2 million will be the trade receivable, the discount received, and it will be as an income in the income statement. So when liabilities are decreasing, we call it income. We are saying that these are increase in assets or decrease in liabilities that lead to an increase in the equity. You know, when the incomes are increasing, it means that income is going to increase our net profit that we are supposed to be taken to the equity section within the balance sheet. So when we put there a net profit which is high, it means we are going to be increasing our equity. So that's what we mean by these increases in assets or decrease in liabilities. They can lead to an increase in equity other than the contribution from equity participants. Contribution from equity participants may be when the shareholders are increasing their share capital, or when the company is selling more shares. When you see that one is not called equity. Sorry, it's not called incomes. It's part of the equity section. So we are saying that these incomes, they must be increasing the equity, but as a result of increase in assets or decrease in liabilities, but not to the contribution from equity participants. The other one is expenses. You know, expenses, those are the ones we less from the gross profit, sorry, the gross income or the gross profit of the organization to get the net profit. So expenses are defined as decrease in assets when assets are reducing in value. It's like you had an asset of 10 million, but it has been valued at, let's say, 8 million. That decrease is what we call an expense. It's a loss or a decrease in assets. Let's say when you're talking about the depreciation reduces the cost of the asset. If it reduces the cost of the asset, we take it as an expense because assets are reducing in value. That's what we call decrease in assets or increase in liabilities. If let's say you are the state, you are given, let's say, provision for, let's say, bad debts, and you find that with time that provision is keeping on increasing, that increase in provision for bad debts is also treated as, remember, the other one is a liability because you're expecting some people not to pay you. They are increasing. If they are increasing, we treat it as an expense. So increase in liabilities is also an expense, but those ones, they must lead to a reduction in equity other than the distribution to equity participants. Distribution to equity participants, we are talking about the dividends. Dividends are not expenses. We don't treat them like expenses because when you're paying dividends, you are just apportioning the profit. Dividends comes after you have already got the profit. You can't pay dividends on gross profit. You pay dividends on net profit, meaning that that dividend cannot be treated as an expense because it comes after you have already deducted all the expenses. So that's why we are in the definition of the expenses, we are saying there must be an increase in liabilities or decrease in assets that reduce. Remember, when you're talking about reducing the equity, this net profit we are taking to the equity section is reduced by these expenses. In other words, it's like we are reducing the equity part of that balance sheet section by these expenses we are incurring. Hope you can be able to get more on that. If you feel you're not contented, you can rewatch the video and be able to understand what we are talking about. So those are basically what we are talking about, the elements. I wanted to first make clear that at least these ones are very understood because we are going to use these same items. If let's say we are talking about assets, we try to talk about the current assets, we talk about the non-current assets in their respective standards, as we are going to be seeing, because when we are talking about the non-current assets, we have a standard for that. There are so many standards that are related to the non-current assets, the tangible one and the non-tangible, the intangible ones. So there are many standards as we are going to be seeing them, but at least you first get these clearly. Okay, we can proceed to the next one and we look at the measurement of those elements. How do we measure those elements we are talking about? If let's say we are acquiring an asset, how are we going to assign the values on those assets? If let's say you have acquired an asset today, which value are you going to attach to that? Those are the things we are going to be looking. How are those assets we are talking about, how are they measured, or how are they assigned values? Those are the things we are going to be looking at when we talk about the measurement of elements of financial statements. One, we have the historical cost. Historical cost is, as the word says, it's something, it occurred sometime back. So it's in history. So we are talking about the historical cost as it's a past cost or something that we had incurred already, but can be used to measure some of those items we are going to be talking about. So when we try to look at how our assets measured using the historical cost, of course, when you're buying an asset, at that point when you have purchased it, if let's say you have bought an asset of, let's say, 10 million, that 10 million is actually what we have, and that's the value that we are going to be taking in the balance sheet. because we don't have any value that we can assign to that other than the one you have actually paid. So when we are talking about the historical cost, is the cost that we have already incurred. So we are saying that if you are assigning these values in the bank statement, in the, let's say because assets are going to be in the balance sheet, which value are we going to use? We are going to use the price that we paid when we are acquiring those assets, or the an amount we have paid at the acquisition date. We are saying assets are recorded at the price paid at the acquisition date, or the amount paid to acquire those assets. If they are liabilities, how are we going to record the liability? If I sell goods on credit to you today, that's going to be bringing a liability, but which value am I going to assign to that when I go to my balance sheet, when I'm taking some of the liabilities? Which value am I going to attach to that liability? We are saying liabilities, they are recorded at the an amount that we are required to settle that obligation. If, let's say, you've incurred a liability of, let's say, 10 million, you've bought goods on credit and they were worth, let's say, 10 million. That 10 million is straight away the figure we are going to be using when we are doing the balance sheet at that point of acquisition, or when we are recording that in our financial statements. The other measurement base, actually these measurements, they are called measurement bases. The other one is current cost, or the fair value. The fair value, as the word is, the other one is, it is the opposite of historical. If something is not in history, it must be current, something that is prevailing at that very time, in a given at a given date. So assets are recorded at the prevailing market price at a given date. We are going to be seeing this, how we can be able to treat these assets using the fair value. We can try to, let's say you bought that asset at 10 million, and right now it's amount that can be got from the market. If at all you are to put it on the market, you get this amount. That's what we are meaning. The amount we can get at the prevailing moment, or at the prevailing date, when you are supposed to, let's say you are supposed to settle the obligation. Someone may give you 10 million and that person is demanding you 10 million, but by the time you come back to pay, you may just say, you know what, according to the situation that is prevailing at this time, just pay me 9 million. Or, since I gave you the money, and as per now the inflation is high, you can give me, let's say, 11 million, and you give me that 1 million as to cater for this inflation and all that. So when you're talking about the prevailing market price is determined by forces of demand and supply. There are so many factors that are within the market that can lead to either the prices going to be high or going to be low. So the current cost is what is prevailing at a given date. So assets are recorded at the prevailing market price at a given date. When we are talking about the liabilities, they are recorded at the amount required to settle the obligation. Currently, what we can pay now, someone, as I illustrated, we said someone can give you 10 million today and says in 2 months time you pay me 9, depending on what is prevailing in the market. You may find that the the situation is hard. Someone cannot be able to get the whole of the money you are demanding the person. You can say, no, pay me this, or you may find the situation is very worse. The inflation is high, and if someone gives you the money you gave to that person, you may find they're giving you less. So to cater for that, you bargain on the currently what is prevailing on the market. The third one is realizable, or what you can be, what you can realize from a certain transaction, or what you can get. It is realizable or settlement value. Realizable is for asset, then settlement is for liabilities. When you're talking about the realizable, it is the amount expected from the asset with less the cost to sell. This is mainly with the goods, or these people who are, let's say, acquiring contracts. You may find that for you to get a contract, the contract, let's say itself is, let's say 10 million, and you find that to get that contract done, you're supposed to incur certain expenditures like paying commission to brokers and all that. Will less that cost. But that one is in terms of, when you're talking about the realizable, most of the times it is what we are supposed to be, we are supposed to be selling. If, let's say, we are selling goods of, let's say, 10 million, and to sell those goods we need to pay, let's say, marketeers or the sales agents so that we can be able to get those goods sold. We less that cost we are paying to them. It's an income to them, but it is an expense to us. You will get what the market is going to give you. If, let's say, in the market they are giving you 10 million, but you have incurred on top of that 10 million you have got, the person who got for you, the person who is going to give you 10 million, you have paid something, you less that one off. That's what we call not necessarily the money you're supposed to fetch from the market, but what you have actually received after removing what you have incurred to receive that money. This is mostly with assets. You know, when we are talking about the assets, even if they may be current, whether they are inventory, you have stock, let's say stock of 10 million, and you're selling it at 15 million, but on top of selling it, you less the cost of 10 million, but that profit you have got, you have also incurred certain expenses to make sure that at least those goods are sold. So when you're talking about this, the settlement value is actually basing on the liabilities, because we can't be settled. You can't be talking about settlement and you expect to be receiving money. It's you, let's say the company is paying out, and we are saying liabilities are measured at an amount that is required to settle the obligation in the normal course of business. It is, if, let's say, you are supposed to pay 10 million, it is that in the normal. But if things go the other way around, you may find that you are not paying exactly what is supposed to be paid. So here we are talking about the amount that we are required to settle, or the amount that is required to settle the obligation in the normal course of business, if everything is moving well. The fourth one is the modified historical cost. It's a modified, meaning we are changing the historical cost. Modified means we may be modifying it positively, or it may be in a negative way. It is a modified historical cost, means assets. This is mainly about assets. We are saying assets are measured at the revalued amount or the estimated market price instead of their historical cost. As I said earlier, that when let's say you have acquired an asset at 10 million, you may find that currently, if you are to revalue that asset now, you may find that that asset is not going to fetch the same amount that you have paid to acquire them. If let's say you paid 10 million, you may find that at the time of revaluing, you find that the asset has, let's say, increased in value and it's now costing 15 million or 20 million. And you may find it is even otherwise. You may find that the asset you acquired at 10 million is now valued at 8 million or 5 million. So we are saying assets are measured at the revalued amount or estimated market price instead of their historical cost. So when you're taking these figures to the balance sheet, you don't take the historical cost, but you take the modified cost. If let's say it has been revalued at 15 million, when you're recording your financial statements, you take the 20 million that has been revalued. If at all you are using the modified historical cost or the revaluation model. Then lastly, in terms of the models, there is the present value. The present value, you can call it the value in use. If let's say the asset is not sold and we are going to be using that asset for a given period of time of its useful life, of course it's economic useful life, you find that that asset is going to be bringing in cash flows. We are going to be getting certain amount of money from that asset. If it is a liability, you are going to be paying a certain amount of money in the future. If you are settling, if let's say you have got a loan, you are going to be paying interest, but that interest is going to be paid in the future. So what if you want to look at the present value, we discount those cash flows that we are going to be receiving from the assets, or that future obligation or future payment we are going to be making on a certain period in the future. We discount it and we get its present worth. Actually, what we are trying to look at, if let's say an asset you bought at 10 million, you are expecting for it to be there for the next 5 years, and you find that that asset can bring to you cash flows of, let's say, 30 million, or it will bring you 5 million for the 5 years, or it will bring you 6, depending on the capability of the asset. You discount those cash flows that you are supposed to receive from that asset for the period you are going to use it to you define their present worth. And how do we get that? To get the present value, we use the discounting factor. The discounting factor is 1 over 1 plus x power n, or someone can call it 1 plus r power negative n, but it is the same. That is the discounting factor. We multiply by those cash flows. We may accumulate them. If let's say we are receiving those 10 million annually for the, let's say, for the next 5 years, every year you're receiving 5 million, but if you're receiving 5 million for the next 5 years, it doesn't mean that it will be 5 million times the 5 years to get the money you're expecting. No, that one won't be its present worth now, but we put in the discounting factor to make it giving us the exact value that we are going to be recording by using that discounting factor. If you are not using the discounting factor, we are going to be using an annuity factor. The difference between an annuity and the discounting factor is that for a discounting for all of it we are discounting the cash flows. But the logic here is when you are discounting cash flows, they may be uniform or they may be uneven. There are those cash flows that we are going to be receiving, let's say 5 million every year for the next 5 years or 10 years. And you find that there are other cash flows you are going to be receiving. This year you receive 5 million, next year you receive 2 million, the other year you receive 10. Then when the cash flows are uneven, we use the discounting factor. But when the cash flows are uniform, we are receiving 5 million every year for 10 years, we can use an annuity factor. And to get an annuity factor, here we are not going to be using tables, but I want you guys to get to be familiar with the formula so that you can be able to compute each and everything using the formula without following those things of it is 1 minus 1 plus r into bracket to power negative n. This is over r. That is our unit factor. Then we multiply by the future value, that cumulative amount you are going to be receiving. If you are receiving 5 million, then it will be that 5 million times the discounting factor for the number of years. This R is going to be our discount rate. Then this N is the economic useful life of the asset. Or it will be the obligation. How long are you going to be taking to be submitting a certain amount of money to an organization? If let's say it is in terms of a loan, paying a loan, that's basically the measurement basis we are going to be using. The reason why we brought out this is that when you are looking at certain standards, let's say standards for assets, we are going to be requiring to know which value is going to be assigned at a given point. It may be at an initial recognition or at an initial stage, or it may be at the reporting. We may want the figure that we are going to be using at the acquisition date when you are acquiring the asset, or at the reporting date. As you know, our financial statements are made annually. That's why we are calling the reporting date, but we are going to be seeing those ones when we start to discuss about some of the standards. We are going to be seeing, actually we are going to be basing on them, and we are going to use this information a lot. If at all you have not understood, make sure you rewatch the video and be able to understand it, because if you fail to get these right, you may fail to get other concepts, because we are going to be referring to all this information in the preceding videos. So we can take a simple simulation to be able to understand at least what we have got. It is going to be rotating about the measurement basis, but when at this point we are putting in the value, you will be able to appreciate what are the items we are going to be talking about. If you talk about the historical cost, how are we going to assign these values initially, or at the acquisition date? So let's take this is about the measurement basis. Called it simulation 1, and says ABC Limited bought a machine with a useful life of 10 years on 1st January 2018, meaning this is the acquisition date, what we have incurred, what we have actually incurred at the time of acquiring. This is when the asset was acquired, meaning this is the acquisition date, and it was, we paid 60 million as our cost that we incurred at the acquisition. And they are saying that the market value of the machinery or the machine on 31st December 2021, meaning this is at the end of the year. If the year is starting 1st January 2018, it means it is ending 31st December 2018. And we are saying the market value was 40 million. And we proceed, it says that for disposal purposes, the machine had to be dismantled and transported to the buyer's premises at 4 million. These are costs we are talking about. The item was sold. Disposal meaning selling off. The asset was sold. But if we are to sell it, we have to incur certain cost. We dismantle the item and we transport it. Maybe this machine was plucked somewhere, or it was constructed somewhere, and they are removing it from where they put it, and they are transporting it to the person who has bought it. And the cost they incurred was 4 million. They are saying that the machine is expected to generate cash flows of 10 million. This is what you are seeing with their cash flows of 10 million per annum, meaning we are receiving 10 million, but they told us the useful life was 10 years. But remember, by this time up to the time they are talking about, there are some years which have gone. That's why they are saying we are going to be receiving this 10 million per annum in the remaining 7 years, meaning we had already spent the 3 years of the asset, of the useful life of the asset. Then they have given us the discounting factor as 10% per annum. Then we have the required is saying determine the value of the machinery on 31st December 2020. Remember, the asset was bought on 1st January 2018, but they want us to make reporting at the time of 31st December 2012. Of course, you know, when you acquire an asset, there are depreciation, impairment, and all of that, as we are going to be looking at them. Because each of those items have their specific standards that are talking about them. So they are saying we determine the value, which value are we going to attach on the item as of 31st December 2020 using 1. Historical cost, current cost, realizable value, and then the present value. These are the things we've been talking about here. We said the historical cost is the cost we are going to pay to acquire the asset. Because here we are talking about the machine, this is an asset. So what we are going to incur at the acquisition period, or at acquisition date. The current value, what is its value right now? Realizable value, what we can get from the asset after lessing off the expenses we have incurred to get that money. Then the modified historical cost is the revaluation. We have revalued the asset, we had bought the asset long time, and now we are revaluing the asset. What will be the value? Then the present value, what are the expected future cash flows that are coming in, and we discount those cash flows to their present worth, and that's it. So that's all basically we are going to be looking at when we are doing this question. So I can go into Excel here and we'll be able to insert here an Excel sheet, so that we'll be able to do that. That item. Let me make it white because I don't want to move out from the screen since we are going to be using the same question. Okay, we can start right away, and we say this is our simulation. Maybe to increase it so that people can be able to see the whole screen. So basically it can move. So you can use this. I think it will be, this is ABC. It is ABC Limited. And we are going to look at, I put some answers. If you try to look at here, I put some answers, but we are going to see how those answers are coming in. As we said, the value, they said the cost was, the cost as at 1st January 2018 was 60 million. But remember, this asset is what this is the amount that we've actually used to get the asset. But we are reporting the reporting date, reporting date is 31st December 2020. So if you have acquired this asset and we are using the historical cost, we are saying this is Roman 1, and we are getting the historical cost. We say that our historical cost is that assets are recorded at the time they were at that amount that we acquired those assets. We acquired them on 1st, but remember from 1st January 2018, it was for 60 million. It can be in Ugandan shillings or in dollars, whichever. So I've not put the units, but you can be able to put whichever country you're watching it from. So the 60 million, remember from 1st 2018 to 31st December 2020, there are how many years that are there. So we need to find how many years are there. You may find that we have from 1st, that is 2018, 2019, then the 2020. 2020 is inclusive because it is at the end, meaning there are 3 years. There are 3 years which are there. So what are we trying to look at? We have, when you have the assets, you know from your financial accounting that assets reduced in the value. It can't be the same 60 million because of the depreciation and all that. We have to spread the cost to its useful life. So we define the depreciation. Permit me to use DPN to represent, let me write it, depreciation. And to get our depreciation, we say the formula for getting depreciation is, can use it is cost minus the salvage value. or the scrap value or the residual value from our financial accounting, then this one will divide by the useful life. If you are not given the residual value, you just take it to be 0. So this will give us, it will be the cost, which was 60 million. We just put 60 million minus residual value, which is 0. We can just divide this, divide by the useful life. They had given us the useful life. Can put here the useful life was given to us. The useful life was 10 years. It is 10 years. So when you get this, we divide by 10. Meaning, the depreciation we are going to be getting here, it is for only 1 year. But remember, we want for 3 years. So it will be that this very figure multiplied by 3. These are the 3 years. Let me put 3 years. Whatever you get, it will give us 18 million, and this 18 million is the depreciation for the whole 3 years. This depreciation is for the whole 3 years. But remember, this whole 3 years, for us, what we are looking for, we want the carrying amount. What is going to be its carrying amount? The carrying amount is got by getting the cost minus the depreciation or accumulated depreciation. Remember, depreciation is for 1 year, but accumulated depreciation, it means the depreciation for 1 year is 6 million. 6 times 3, because it is 60 divided by 10, which gives you 6 million. That's for 1 year. But we want for for 3 years. We multiply 3 times 6, we get 18 million. So our cost was 60 million. Then when you less the 18 million accumulated depreciation, you will be able to get 42 million. And this is how we got the answer you are seeing here. This is how we got this 42 million. It is basically from that computation that you are seeing here, that 42 million. So that 42 million was there. This is what you are going to be recording in the balance sheet. If they are telling you the balance sheet extract, you get this figure, as we can say the extract here. You get the where there are assets, you say machine, its cost was this 60 million, accumulated depreciation of this, then the net book value. Of course, the carrying amount is the net book value. I know you guys are used of the net book value, but here we are talking about the carrying amount. But carrying amount in this sense is the same as the net book value, or what this is basically what will be there when we are using the historical cost. That is the value we are going to be using when we are reporting for historical cost. This is what you basically you've been doing in your financial accounting when you are handling the depreciation and all that other items. Then our part 2 says they want the current market value. When you look at this question, it says the current market value, but in the question they told us that the current market value was given to us. This is basically, actually this one was supposed to be 2020. This question, this one was supposed to be 2020. This one was supposed to be 2020. Because it's the current market price, this is supposed to be 2020, not 2018. It was given to us as 40 million. So this one was okay, you just get it in the question. Hope you can be able to adjust that, or I can change it from here. And I see this one was supposed to be 2020. Supposed to be 2020. So we can proceed and make sure we will complete the question. Our Roman 2 was talking about Roman 2 was, we've got it, it was 40 million, it was given to us in the question. Then we look at the Roman 3. The Roman 3, which was the realizable value. I said the realizable is for assets, then settlement is for liabilities. That's why here they are asking for realizable. What we said with the realizable is that it's our estimated selling price minus the cost to sell, or the costs we are incurring to sell those assets. And here they gave us in the question, they are saying that for disposal purposes, the machine had to be dismantled and transported to the buyer's premises at 4 million. But remember, they gave us the cost, the market value. Market value is what we are estimating to get from the market. So if we are given the estimated market price, the market price was 40 million, and the selling, they have given us the transport and the dismantling cost, which we call the cost to sell, which were 4 million. They were 4 million. So to get our realizable value, we said it will be, this will be equaling to the estimated market price minus cost to sell. Cost to sell. When you get this minus this, of course you'll be getting our realizable value. and the value here is going to be 36 million. It will be this minus this, which will give us 36 million, and this is going to be our realizable value. When you check from here, I gave it to you as 36 million. Then we can go to our last one, which is talking about the Roman 4 is talking about the present value. And our present value, we said it is equaling to the future value multiply by the discounting factor. And we say that our discount factor is 1 divided by 1 plus R to power n. And this n, these are number of years, but they told us, as per this time, they had given us the machine is expected, this one I also repeated it, you can remove that one. The machine is expected to generate cash flows of 10 million per annum in the remaining 7 years, meaning our n is going to be 7 years. Our cash flows, we are going to be receiving 10 million. The discounting factor is 10%. So we have all the information, we can just fill in here and we get all that what we need. Our n is 7 years. Our cash flows or future cash flow, what we are expecting to get in the future. Future cash flow is 10 million, but remember we are getting this 10 million we are not getting it at once, for the remaining 7 years. So our useful life is, we got it, and we got our discounting factor as 10%. So we can do that one from here. There are two methods I said. We can use the discounting factor or we use the annuity. And we said, but we use annuity only and only when the cash flows are uniform. We are receiving 10 million every year, but if the cash flows were varying, we use the discounting. Let me show you method 1. So method 1, we are using the discounting factor, and we get them, these are number of years. We put there our n, number of years. We said we are receiving cash flows for the last 7 years. 1, 2, 3, 4, 5, 6, 7. We're receiving for the 7 years. Then we have the cash flow, or that future cash flow. The cash flow is we are receiving 10 million every year for the 7 years. This one we are working in millions. I can put those, let me put all the zeros. One, two, one, two. I hope they are 10 million. Yeah, that's 10 million. Then we will get our discount factor. It is called R, which is 10%. Then we get our present value. We said it is 1. This one we can use Excel. It is 1 divided by, put it in the bracket, it is 1 plus our 10%. When you convert it to decimal, it will be 0.1 plus 0.1, it is to power. Now this n, our n here is 1, it will be to power 1. And press enter, you will be getting that. But you can reduce them to 3 decimals. Reduce them to 3, maintain the 3. Sorry. Remember, let me just put this. We can lock this one because let me put the 10% here, so that we'll be able to do it using Excel, not doing it manually. Instead of putting this 10%, I put the exact figure. I put this. Then I lock this one, meaning the other one they are going to be changing. I think you know how to do those things in Excel. When this value, it means when I put in these dollar signs, it means this 10% is going to be fixed, not changing, but only this outer part which is going to be changing. That's why I put in the dollar sign. But if you don't put in the dollar sign, you will not get the same answer. Hope you can be able to get those, and that's Excel. I'm not teaching Excel. It is equal. Then to get the present value, we said we get the future cash flows, we multiply by the discount factor. So it is going to be this multiply by this. Then we can to get those figures. Then we get the totals. Actually, this total is going to be our present worth. Total can equal sign sum the sum in this so these are going to be our figures. I can put in the let me put in the separators so that the work looks a bit fine. These ones I have to remove the separators. This is a bit of Excel and its own ways. So these are the figures. So this is going to be our present value. Total present value is going to be this, and that's the answer they were looking for. This is the answer. So we can use the method 2, where we are talking about using, this is method 2. Method 2, and this method 2 we are going to be using our annuity factor. There are those tables, but those ones we learn them in financial management, but here I'm not teaching financial management. You learn how to use, actually I did some videos, you can cross check from there, and you know how to do those ones using the annuity factors, and you get the differences from there. So remember, we said if the cash flows are going to be coming uniformly, or they are going to be even, coming in equal installments for a certain period of time, we just get those installments, which is 10 million. After getting those ones, then we get our annuity factor. Actually, to get that annuity factor, you can even sum up this. When you sum up this, let me teach you something here. Cosine sum. I'll verify to you this. This answer you are seeing here is exactly what is going to be our annuity factor. This one, but we'll get it in the annuity factor. We'll get it in the using the annuity formula. We say the annuity formula is 1 minus, let me just put them in Excel. Let me put it here. Annuity factor is equaling to 1 minus, open the bracket, 1 plus R, close the bracket, to power, it's a negative n. But the whole of this one is in the bracket. The whole of that is divided by R. Divided by R. That's the formula. That's what we are going to be using to put in our formula here. This is going to be our unity factor. It is going to be cosine our, we can first open the bracket. We say 1 minus, open another bracket. It is 1 plus our 10%. Let me just use this. Or you can type it there. Then it's close that bracket. It is power negative 7. Then you close that bracket. We divide by this. When you press enter, it will give you exactly this figure you're seeing here. That's what I've been talking about. What it means is that this unity factor is what we can get for the whole of those periods. It is the accumulation of all those periods that are remaining of the useful life of the asset, which were 7 years. That's why this one is summing up to this. So if you get this times this, you'll be able to get this. It is equal sign. To get our present value, it will be this. We multiply by this. So let's by this. It will be giving us the same answer. This is our present value. And when you check here, we said it is 4.86 million. That's what we've been talking about. So those are the figures. I hope you guys, you can be able, let me remove, I can remove the grid lines, and you'll be able to see it clearly. Hope you can be able to see. Let me make it blurred. Hope you can be able to see all of that. That's the working for the things we wanted. This is our realizable value, this is our cost using that, and this is our those two methods. And I hope you can be able to learn something out of that. So thank you for watching, and the next one we are going to be looking at is going to be something new, and we are going to be seeing how to do all that. It's going to be something new. Can try to change the color if you can't see it well. At least from there you can be able to see it. So those are the things we are going out. That's how we are going to be seeing them. But the next one we are going to look at is we are going to start our IS 16, that is PPE, in the next video. But hope you guys, you have enjoyed this, and I want you guys to subscribe so that we'll be able to learn more, because more is coming. It's just matter of subscribing to the channel and share the videos. You can comment, you can make any suggestions. I welcome all of that, so that we'll be able to understand and we do our CPA with ease. Thank you for watching, and until we meet again the next session, that is going to be about the IS 16, that is property, plant and equipment. Thank you.